Hey, hi. Yeah, so today I think yesterday was there was a big swing yesterday, with market opening um, where Nasdaq actually went up by 1.5%, and you get some of my favorite stock picks like Innovix and all that was up 20 over percent, and then at the end of closing it kind of like came down to a negative of like 5 to 6%. So that was a huge big swing for many companies. So what has been happening right now is totally, I think, has never happened before. Usually when Fed increases interest rates, um, company earnings should come down, and the GDP should drop, and to even below zero, which is if it's two consecutive quarters of negative growth, it means a technical recession, and jobs, unemployment rates should be spiking up because companies are making less profits. They will have to shrink down their staffs and reduce spending. But the thing about here is, and then of course inflation will come down. But here what we have been seeing right now is interest rates are at all-time high in 22 years. But jobs are going up. There's no earnings apocalypse happening, especially what we have seen right now in for the about 46%, 47% of companies have already reported their Q2 earnings. There's no, doesn't seem to have reports on earnings apocalypse, and some have even kind of like give a very positive Q3 guidance as well. So it is very strange on what the direction of this market looks like. Apparently you can see that there's actually a lot of money in surplus of money in the market, so that's why the massive hike in the interest rates, and we are still not sure how the effect of this higher and longer high interest rates regime will affect an economy. But so far in the short term, it looks like there's little to no effect to slow down an economy. But the good thing is, even though market is hot out there, inflation has been tamed. So I just want to show you a couple of very interesting video on all the positive data that's coming up, that are showing signs that even at this market, these high interest rates, the GDP growth and all that has been very positive.
Just waiting for a major type of pullback or something. I'm going to show you that interview, as well as some definitely key levels to watch out for on the big ones that could bring down indexes if that's the case. But this is going to be rapid fire on this economic data, so pay close attention right here. And here's the good stuff that the market reacted to. Okay, it was GDP, bam, comes in at 2.4% above expectation, which was the key of the day. Everything came in above expectations, as you can see right there. So again, economy is still strong. Then personal consumption, 1.6% up versus 1.2% estimated. You can see right there, okay? Still spending. U.S. GDP, personal consumption, core price index continues to go down, okay? So that is a good thing. Then you got business spending plus 7.7%, which is the strongest we've seen since Q1 of 2022, as you can see right there. So that is still going up, and actually had a very good quarter, as you can see. Then what do you got? The hot job market, man. We hadn't hit this number in a while. 221K versus 235K, came under as usual, and continuous claims 1.69 million versus 1.75 million. So it is going in the opposite direction of what the Fed wants. Okay, so less people are needing those claims, less people are continuing on those claims because there's still jobs out there. And again, you're getting paid $15 to flip a burger, or somebody said, to push the press down on the burger. You don't have to flip them anymore because you probably get carpal tunnel now. But so you don't have to worry about that. And what is that leading to? You now have 46% of companies reported, and now you have the Q2 GAAP earnings per share up 7% over last year, the highest year-over-year growth rate.
Yeah, I mean, you'll see that there's like a big dump of so many different data, but most of them are pointing to positive growth in the US. We are still not sure how it will affect the other economies or other countries. Well, usually in a high interest rates regime, especially for value stocks, right, where they are pretty much a stable company, where their growth are pretty much in like 4%, 5% per annum, or 1 to 2% per annum growth or expansion in what, let's say, food products or energy sector or logistic, DHL and all that. So if they have a high loan of like 4 to 5%, technically you will set off each other. Let's say 6% of profit and over 4% of debts, interest rates that they need to pay. Unlike previously, before the pandemic, it was like 0%. So their net income actually should be reduced to 2%. So valuation should be adjusted to reflect the lower earnings. Of course, not and plus, unless they have like pricing power, they can actually price up with lower revenue but maintain their profit margin.
Since Q4 of 2021, and the other thing obviously is going to help, like I said, the dollar is still weak, okay? And you saw that today in some of the earnings, right? Meta absolutely destroyed earnings, raised their revenue guidance from 32 to 34.5 billion. The estimate was 31 billion, right? They obviously killed it, earnings per share as well. Then you got McDonald's. I told you how much they're charging for those freaking hot fudge sundaes, didn't I? Not a joke, right? The company reported global same-store sales at 11.7% versus 9.4% sales growth expected, right? And then same-store sales rose 10.3%, over a full percentage point of what was forecasted at 9%, right? And there was some more earnings came out today. I know Roku, Intel, all of them are up after hours, so keep that in mind. And then here's the negative part, right? Once again, the market does not care about this, it seems like, but the manufacturing.
So you can see the manufacturing prices were coming down, and McDonald's are doing really well in the second quarter. McDonald's would be an unusual case actually, because I read a documentary about comparing McDonald's, Burger King and KFC worldwide, and then they have a special look in China whereby KFC and Pizza Hut, not Burger King, had about 7,000 plus outlets, whereas McDonald's only have about 4,000 plus. So there's still huge room for growth in China for McDonald's, and which will reflect in their bottom line. So yeah, so there you go at the moment. So this has never happened before, and we are not sure how things will pan out. So it's like a toss of a coin. So yeah, I hope you liked the video, and reaction video to this YouTuber, Mike Jones. Credit to him for compiling those data, and please subscribe to the channel. Thanks, see you soon.